Gold's rally is nothing like the 1979-1980 blow-off top. Gold is up over 43% this past year, a move Data Trek calls statistically unusual but not unprecedented. Since 1975, average annual gains are 8.2%, making today's rally fall between 1 and 2 standard deviations. Compared with history, as you can see on that chart there, it's not like the 79-80 inflation surge. It's more like the 2006-2011 run with the dollar weakness and the financial crisis and the Chinese stimulus drove demand back then.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. Vince Lanci. It's 7:35 on Tuesday, and this is the Goldfix Market Rundown. We have a slightly ambitious program today. We'd like to give a market recap to say where we are. I think it's time for one of those. We like to compare the rally to what happened in 1979, which is a concern. Is it a blow-off rally? And finally, I read a report the other day. Thank you to Zero Hedge for that. And in that report, there was a stark or harsh reality about where we are economically and what our goal is. And the goal is to engineer a bubble. And I'd like to go through that a little bit because aside from everything else that's going on in the world geopolitically, domestically, this is what's going on right now, and we are engineering a bubble. Like Hartnett has said, we need a bigger bubble. Well, that's what they're doing now. I think this might be one of the big drivers behind gold. So let's start. Starting with where the markets are now. On your screen, top left-hand side is silver. Top right-hand side is gold. Lower left-hand side is the DX. And the lower right-hand side is the GDX, or the gold index, Gold Miners Index, versus the S&P 500. As it goes up, that means the GDX is getting worth more relative to the SPX. 10-year yields are 412, 413, down 2. The dollar is 97.35, up 5. The S&P 500 is down 2 handles at 66.89. The VIX is 16.08. Gold is 37.82, up 36 and change. Silver is 44.29, up 27. Copper is 455, down 2. WTI is 63.39, up 66. Natural gas is 277, down 2. Bitcoin is up 250 at 112, spot 900. Ethereum 4100 and change. Platinum, palladium both up again, 2% plus each. Gold, silver stable at 85, not really moving today. And grains are mixed, with wheat bucking the trend and is a little bit higher. Let's talk about yesterday. Gold finished the session yesterday at $37.45, up about $61 or 1.66%. The move was decisive, carrying the market above recent resistance levels. Silver outperformed, closing at $43.98 after breaching $44 intraday, with a gain of 93 cents, approximately 2.1%. Copper advanced modestly to 457. Platinum rose 1% at 1416, while palladium gained 2.5% to 1811. Miners were the standout story. GDX climbed 2.7% to 74.33. Wow. Silver miners blew that away, 3.5%, and junior silver miners exploded at 5% higher. I'm going to skip the broader markets for now, but I do want to put some context on everything that's led up to yesterday. Momentum is gaining in gold ownership. It continues to build as prominent institutional voices add their weight. Morgan Stanley CIO Mike Wilson recently advocated a 60-20-20 portfolio with 20% allocated to gold. Ray Dalio reinforced his view of gold as a necessary hedge. Investor Jeff Gundlach suggested that 25% of one's net worth in gold was prudent. This shift has been underway for months, beginning with recommendations from major houses such as Goldman Sachs to substitute gold for bonds. We covered that. These endorsements are more than opinion now, in our opinion. They carry weight in shaping institutional and retail behavior. You see what's happening in the market as a result of that. I also believe it signals a policy shift. Without being too conspiratorial about it, a broader interpretation suggests a tacit approval at a policy level. In the past, explicit gold endorsements from American institutions were avoided unless tied to the dollar or rates. We think rates are going to go up, sell gold. We think rates are going down, buy gold. But direct recommendations to buy gold were seen as sensitive given their potential to undermine confidence in the US currency and the equity markets. That taboo appears to be lifting. I almost get the impression that banks like Morgan Stanley know something's going on and they need to make sure they've recommended it before it happens. Just me. At the same time, multiple real factors contribute to the bid. The ongoing trade war, uncertainty around tariffs, crisis conditions in London, LBMA I'm referring to, U.S. repatriation of gold, and persistent talk of revaluation. It is persistent. I think it's going to happen. Inflation concerns coexist with recession fears, hence stagflation. The Federal Reserve has returned to easing. China has taken delivery of large quantities of bullion, the warrants. Each of these points feeds into the narrative of preparation for a larger structural shift, a reset, if you need to call it that, of some sort. Silver's designation as a critical mineral adds another layer. Metal wars is the expression that Josh Fair called it. This aligns with the Metal Wars framing, I already wrote that down, where strategic competition over resources reflects mercantilistic behavior. Silver miners' strong performance yesterday underscored the relevance of that designation. The U.S. can hoard silver now, and they don't have to tell you about it. So what do you think's happening? All that silver going into SLV? What do you think's buying it? Or some of it anyway. The rally has prompted discussion about whether a pullback is imminent. Now, while short-term profit taking is natural, it's easy to underestimate the purchasing power of the U.S. public. Exposure to gold and miners remains marginal, like abysmally marginal relative to equities, and even small reallocations can drive substantial flows and price dislocations. The key question is whether inflows into metals occur alongside rising equity markets or during broader equity sell-offs. In the latter case, stagflation concerns would accelerate the divergence, with miners rallying while the rest of the broad market dropped off. That will be your stagflation concern. This dynamic has historic precedent. The message I'm trying to give you is, you may not remember, you may not be old enough, and I'm not even old enough, but miners went up when everything else went down. It doesn't have to be miners go down with stocks. From a technical perspective, the market is entering the fourth or fifth week of a Bollinger Band breakout on our system on the weekly charts. That's gold. In bull markets, resistance becomes irrelevant, though, while in bear market, support provides little protection. The absence of selling pressures near 3707 was notable, reinforcing the strength of yesterday's breakout. Closing thoughts on yesterday. The day underscored the scale of investor appetite for metals and miners. A weak dollar, institutional endorsements, and a complex geopolitical environment combined to deliver strong gains. The trend is reinforced by both technical and fundamental signals. Finally, markets are preparing for something, even if the details remain unclear, whether framed as diversification, protectionism, mercantilism, or strategic hedging. The trajectory of flows into precious metals appears durable, and the interest is growing. It's sticky. This is not your normal rally. Moving on. Gold's rally is nothing like the 1979-1980 blow-off top so far. Gold is up over 43% this past year, a move Data Trek calls statistically unusual but not unprecedented. Since 1975, average annual gains are 8.2%, making today's rally fall between 1 and 2 standard deviations. Compared with history, as you can see on that chart there, the 1979-1980 inflation surge was more like the 2000. It's not like the 79-80 inflation surge. It's more like the 2006 2011 run, with the dollar weakness and the financial crisis and the Chinese stimulus drove demand back then. Today, central bank buying and investor hedging against inflation, tariffs, and policy risks are fueling the move. Another 40% is unlikely, getting us to the 1979 era. But conditions remain supportive for continued upside. The full analysis on that is in the Premium Post. Gold's rally is nothing like the 1979 blowoff. Now, this analysis that we broke down was done a week and a half ago, and we broke it down a couple days ago. And since then, gold has gone vertical. So we could be entering a blow-off type of situation. I'm not trying to cause war. I'm just trying to say that it's nothing like 1979, 1980 so far. I personally think that there's news coming out, and I think macro discretionary has been front running that news. And I think the banks are now front running that news with their policies. Next. Okay, I don't have any notes on this, but it's pretty important. I did a piece, I did a voice piece the other day called The Stark Reality for America, and it was a little bit doomy. I mean, I could be doomy. It was doomy for a reason, though. I had been looking at the US situation, starting when Trump got elected. And that situation is, this is what we have to do to excel in the next economic reality. The next economic reality being we have to export more than we import. We can't borrow to grow unless we borrow from ourselves. And we must do this while keeping the American consumer stable so the engine in the car is continuing to run. And you saw Trump go through those things, or try to go through those things. Cut back on spending that we don't need so you can spend on stuff that we do need. And that didn't happen. That was the Doge shortcoming. But, now the world has woken up to a new reality. I had read a post by T.S. Lombard titled there, "Pal to Save Jobs and Worry About Inflation Later." That's exactly what we did in the 1970s, folks. Exactly. You got a Fed with a dual mandate, inflation versus jobs, and they're always worried about inflation until the jobs drop, and then they get worried about jobs because they're more worried about recession and depression than they are inflation and hyperinflation. So, touching on that note, I want to put a couple charts up to that effect. This should really bring it home from a macro perspective of what's going on. That chart there. Now, there are three lines. The dotted line is nominal GDP, the US GDP. The monetary base is the blue line, and market value of US stocks is the black line. There are a lot of takeaways from this, but what I'd like to draw your attention that we're going to discuss here is that for the most part, until approximately 2009, the three lines had a relationship with each other, a correlation. And then after 2009, when the QE era started, stocks took off, keeping track with the monetary base. That's the government steering money into stocks that it's printing. GDP, however, even though it rose, did not keep up. So there's a lot of takeaways from that, but one of them is simply this. Printing money made stocks go up, and it helped GDP, but to what extent? So that asset inflation, if that asset inflation goes away and we go back to the dotted line, we're done. We're dead, okay, as an economy. And so Trump is spending, the United States is spending to build manufacturing. Data centers are the one that you see. Data centers are being built because we are in the hope that 1, 2, 3, 5, 10 years from now, we can get the nominal GDP dotted line to slope up to the stock price. We're actually trying to get the real economy to match the fictitious economy. That's a good thing, right? Yeah, but it's hard. You can't just do that. Even if we spend the money properly and it goes to the things that need to be done and the jobs get filled in the proper way and people are productive and unemployment doesn't go to infinity from AI, even if we do all that, who's going to buy our stuff? We don't get along with anyone now. No one's going to buy our stuff. That's down the road, but just right here, right now. What's easier, building a factory or getting that nominal GDP up by letting inflation rise? What's easier to do if you're a politician? That's what's going to happen. Next chart, same report. This is a chart of owners' equity in their houses versus owners' equity in corporates or stocks. So it's stocks versus real estate. Okay. Stocks are the black line, the dark line, and the blue line is real estate. Now, there's several things you can take away from this, but I want to draw your attention to this. In 2000, between 1985 and let's call it 2000, real estate was flat to slightly on a downtrend compared to stocks. And 1999, what happened? The stock market crashed. And then the government said, we're going to engineer another fucking bubble. And they engineered the housing bubble. And then you see housing properties go up. That's an engineered bubble to make the economy on average survive. So we went from stocks being the piggy bank to real estate being the piggy bank. And then in 2009, what happened? That blue line plummeted. And then we said it's back to stocks being the piggy bank. And then you had QE and they steered money into stocks. Okay? So the amazing thing about this chart is, despite the housing crisis that you hear so much about, people have more money in stocks than they do in their house. This is a disaster. This is a bubble. So this is what we do. We engineer a bubble. When it deflates, we engineer a new bubble. Look at commercial real estate collapsing. Let's build data centers. Boom, rescue commercial real estate. This is a fucking disaster in the making. Now, why is it a disaster? Why can't we rescue ourselves? Well, we can rescue ourselves. I'm not bearish America, but I am saying this. The world is no longer playing by our rules. And so as a result of that, we actually have to produce shit now. We can't engineer production of shit. We've got to make stuff now. And that means there's no other bubble for us to create to put people's money in. That means we actually have to start making stuff, which brings us back to this. GDP has to go up to justify the stock valuations because QE distortion of equity values remains in place and cannot nor will not be unwound. It's an engineered bubble. And until they can find something else to replace it with, they're not going to let it go away, which explains partially why miners are up. It explains partially why they're letting gold go up, because it's staying in American stocks. While all this is going on, while we're trying to get our economy to meet our valuations, to get the reality, meet our pipe dreams, the rest of the world is now saying, you don't need $600 billion to do that. You can do it with 20 million, 20 billion, whatever the number is. I don't care. But the point is they're saying the U.S. has inflated asset values. This is the war with China economically. China's saying we can do it cheaper. Don't put your money in the U.S. Now, nobody's going to put their money in China, at least not in the West. But this is the war we're in now. It's our influence over the world economy, the neo-Keynesian influence, which is what that is going away. And as you abandon neo-Keynesianism, you have to go to a more orthodox economic model. And you have to actually make stuff. Anyway, this is why gold is up. Because if you're a macro discretionary fund and you're looking out there and you're saying, the U.S. has to get its economy up to snuff to match its stocks. Are you selling stocks and buying gold? You might be. I wouldn't. They're just buying gold now because they're already long stocks and gold is their hedge for stocks. I'm telling you, either we get really, really productive without firing people, or we're going to inflate the shit out of this market. And that means your buying power is going to drop. And that means you better own something like gold or silver. Anyway, rant over. And that's why I was so depressed doing the Stark Reality for America piece. And I actually think they're going to revalue gold. The chat has been robust. Lots of cool stuff in there. Good morning to the guys. Remember, we're in week 4, week 5. Coming soon. We put out Rethinking the 60-40 yesterday, and we put out Where China Pauses, India Buys, hat tip to Ross Norman. And we have these other stories that are coming up today. But you just wanted to get everyone caught up because things get pretty heady, and you have to take stock of what's going on. Anyway, data on deck, PMI today, which could be very important, and Powell speaks. I'm not sure the details of when and where. I'll look it up. But yeah, there you go. Throwing in the towel on inflation, focused on the economy now. That's it. Thank you for listening. And one of the things that I just want to finish on this note. Where is that? There it is. Gold is being occupied now. I woke up thinking of don't invest in gold, own gold, right? But I noticed from a note that no one is taking profits. No one's taking profits. There's an event on the horizon that they see that we don't. And I said, they're just occupying gold. They're just going to sit in gold like they sat on Wall Street until something happens. Gold is being occupied now. Anyway, I thought it was cool. Catch you later.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.